All right. Good afternoon. I hope you are all well. Okay. To continue with investment fundamentals today, we'll be talking about or we'll be dealing with week 2 and week 3 together on the course outline. So week 2 and week 3 covers asset allocation decision and also mutual fund and investment companies. So under these, we are going to look at what is asset allocation, risk management strategies, risk avoidance, risk anticipation, risk transfer, risk reduction, and the individual life cycle as an investor, and then the portfolio management process, investment objectives and constraints, the importance of asset allocation. Then we'll end up at risk and return history. So in the next session, before we come in and cover up the week 4 and week 5. Okay, so let's hop in, or let's hop on the slides. All right. So what is an asset location? Right. An asset location is basically spreading. Hey, sorry. It's the process of deciding how to distribute your wealth among asset classes, sectors, and countries. So it's basically the process of what? Spreading your money across investments, right? So an asset class is comprised of securities that have similar characteristics. So whether cryptos, whether stocks, whether bonds, and the likes, right? So similar characteristics, attributes, risk, and return relationships. So asset allocation decisions. So there are 4 basic decisions in an investment strategy. So anytime you want to invest, you think about what asset class should I invest in? Right? What type of asset should I invest in? Should I invest in bonds? Should I invest in stocks? Should I invest in cryptos? Should I invest in real estate and the likes? Then you also look at what should be the normal weight for the assets, right? It is not advisable for you to invest all your money in only one class of assets. It is advisable that you spread it among classes. That's why we are treating this topic under asset allocation, right? So spreading it among classes of assets. But if you put it in only one asset, yes, when profits come, you will make profits. And when loss comes to you, it will affect you hugely, right? Okay. So what should be the normal weight? Whether you are going to invest 70% of your wealth in stocks and 30% in bonds, or whether you are going to, let's say, spend 60% in stocks and then 40% in the bonds. So the third point is, what are the allowable range for the weight, right? So what ranges will you have less risk when you invest? Whether when you invest between 60 to 80% of your money, you are going to have a moderate risk or a small risk or a high risk, and bonds to 20 to 40%. So you are going to consider those kind of stuff. And then the last part is also what specific securities should be purchased. So if you want to purchase stock, okay, what company stock should I purchase? Should I purchase Nvidia? Should I purchase Tesla and the likes? When it comes to bond too, you are going to ask yourself, what type of bond should I purchase? Should I purchase the government bond, or should I purchase any other bond? You get it? So there is something interesting here, right? An investment banker or somebody whose income fluctuates is like a stock. So if what this means is that if your income fluctuates, it moves like a stock, and it is therefore advisable to invest in bonds, right? But if you have a stable income, right, then it is what advisable to what diversify and then invest in stocks. So if you have stable income, invest in stocks. If you don't have stable income, invest in bonds, so that there can be like some kind of diversification in your life. So an example of asset allocation based on an investor's risk appetite. So we have some nickname called chicken. So when we say you were checking, what it means is that your income is not stable. It fluctuates. So with that one, you have to invest less in stocks and then more in bonds. And you have to also keep some of the cash since it is not what? It is not stable. And your expected returns will be around 5%. Then middle of the road investor, or like someone who have a moderate or a normal kind of income, right? For you to, you can also invest 50% in stocks and then 40% in bonds, and then keep 10% cash, and you have unexpected returns of like 8%. Then someone whose income is extremely stable, we call the person venturesome lion. So, so with that one, you keep only 5% since you know that you get cash, your income is stable. And then bonds, you have to invest like 15%, and then 80% in stocks, and then your expected return will be around 15%, right? Okay. So the importance of asset allocation, right? So in- asset allocation helps us in so many ways. If you invest in multiple kind of investments, or like um, commodities, you have a lower risk, right? Because you are investing in a whole lot of assets, you have a lower risk of what, losing your capital or making a huge loss, right? So asset allocation is very, very important. So about 90% of returns variability over time can be explained by asset allocation. About 40% of the difference between returns can be explained by difference in asset allocation. Right. So this investment fundamental course, for example, is like, it's in my field because I do this kind of investment and also trade forex. So I'm really, really getting like more insight from this course. So importance of rebalancing here can be that it prevents portfolio from becoming more risky. So if you see that, oh, my portfolio is becoming more of stocks rather than like more of stocks and less of bonds, then you can do what? Cash out some of your stock money and then put it in bonds so that you what? Maintain a balanced portfolio. The recent winners are cut in favor of exposure to recent losers. High prices reduces returns and vice versa. So we also have rebalancing is a strategy for the long term. Because if you really want to stay in this market or investment for a long time, you have to be rebalancing your portfolio so that you what, have a constant kind of return on your portfolio. Rebalancing can be done by directing flow of regular savings to underweighted assets. So that's what I said. If let's say stocks is giving you more money, right? And then bonds is giving you less money. You can try and then what? Invest more in the stocks because now it is giving you more money. So risk, return history, and asset allocation. Looking at return data on various asset classes indicates some important factors for investors. Over a long time horizon, stocks have always outperformed low risk investments. So the additional risk of stock investing higher into bracketary return standard deviation over short term horizon all seems to all but disappear over time. Then we also need to consider real investment returns over taxes and costs. So difference in assets allocation and cultural difference. Difference in social, political, and tax environment influences asset allocation, right? For instance, 50% of pension fund assets are invested in equities in the US, and then 78% in equities in United Kingdom, where high average inflation impacts this choice. So it changes due to high inflation. Then 8% in equities in Germany, where generous government pensions and greater risk aversion seem to play a strong role. So managing risk. Since risk drives expected returns, investing involves managing risk rather than managing returns. So me, for example, me being a forex trader on my Telegram channel, what normally happens is that whenever I will send a trade, the first thing I will send is to send stop loss. So the stop loss is basically a point where I'm expecting the market to close me down when I hit a particular amount of loss. So I always bring in the stop loss first before the profit point will come in, because I'm more looking at the risk than the profit. That's what it means here. So we have to what? Be managing risk rather than managing returns. So risk management strategies, we have risk avoidance. So basically, it's more or less like avoiding risk, but you can't avoid risk when it comes to investment. So you can avoid any real chances of loss. Generally, a poor strategy, except for a part of an overall portfolio. Example, down payment for a house, car purchase, or university fees. Then you have risk anticipation. So with this one, you're anticipating maybe a loss might happen. So you've allocated some amount of money for that. So position part of your portfolio to protect against anticipated risk. So for example, on my forex trading Telegram platform, whenever I send a trade, I set a stop loss. So the stop loss will be like an amount that will be taken out of your account whenever market gets there, right? And will protect you from losing your whole amount of money in your account. For example, maintain a cash reserve, 6 months living expense, and then insurance. Life insurance coverage should be 7 to 10 times an individual annual salary. So we also have risk transfer. So risk transfer can be in the form of you transferring your risk to others. So sometimes businesses hire or secure their debtors with insurance. So what this will do is that whenever there is any kind of bad debt, the insurance company is going to pay that particular amount, right? Huh. So they can also hire or sell their debtors to others. So what they will do is that maybe uh, the debtors portfolio is around 100,000 and they will sell it at 80,000 to someone. Then the person will go and then force and then get all the money, or maybe the person might not be able to get all the money. So you've what transferred your risk of maybe losing those amounts at a reduced rate to someone. That's what it means. To allow for transfer of risk, offering at a price premium to another investor who is willing to bear the risk. So the thing is 100, and then you've what giving it out at 80, right? You've giving it out at 80, and then the person is going to bear the distance. So that's the same thing here. So here, insurance and other investment vehicle they can allow for transfer of risk. So you can transfer your risk to someone, and then at some kind of small profit, then you let the person go and then bear the full risk. They also have risk reduction. So risk reduction is more of the asset allocation. So once you're able to allocate your investment on different kind of assets, you have a high rate of what risk reduction, because since maybe you've invested part in bonds and part in stocks, both of them cannot go down at the same time. When this one is going down, this one is going up. But at least there's a kind of what risk reduction. That's what it means here. So now we move on to the individual life cycle. So individual investor life cycle, for example, after this, we have to start investing. If you cannot invest, for example, do small. All right. So the individual investor's life cycle can often be described using 4 separate phases. So we have the accumulation phase, we have the consolidation phase, we have the spending phase, and then we have the gifting phase. Yes, in here. So the accumulation phase is the early middle years of career, where you are like newly employed and you are making some small amount of money. Here, you are attempting to satisfy intermediate and long-term goals. That is short-term. We have the short-term being car, marriage, and then a house. Then your long-term goals is the retirement and then children's school fees, right? So here, your net worth is usually small. And sometimes, for example, you might be owing plenty, right? So we being in this accumulation phase, we are owing plenty. And our net worth, our money is usually small. Long-term, so we also think about long-term investment horizon, which means that we are usually willing to take moderate high risk in order to make above average return. So at this stage, that's why you can see young people betting like very huge amounts in the lights. But betting is not an investment. So invest. So there's an advice here for us to what? Invest early and regularly. So here is an initial investment of 1,000 Ghana cedi at an interest rate of 10% per annum. And then you are willing to retire at the age of 65. Further, you are planning to what? Invest 200 cedis each and every month. You can break this down and then change this to 100. If you are not working now, you can change this to 100 Ghana cedis and then change here to 20 cedis. And then see the impact it will start having in your life, like at least 10 years from now. Getting. So now, if you are willing to invest this and this, then your 1,000 Ghana cedi from 25 years up to 65 years will now be 45,000 Ghana cedi because of the interest rate. Then your 200 Ghana cedi monthly annuity will compound and then it will become 1.2 million Ghana cedis. So when you add the two, you are going to get what 1.3 million Ghana cedis. It's not small. Let's say you are not able to what invest when you were 25 years, or start this when you're 25 years, and then you started when you got to 35 years. So 35 years up to 65, you are going to make 17,000 on of your $1,000 investment. And then your 200 Ghana cedi monthly compounded will now be 452,000, right? And this will give you a total return when you retire of 469,000 Ghana cedi, approximately. So that one too is there. And then if let's say you didn't invest at 35 years and then now 45 to 1,000 Ghana cedi will change to 6,727. Then your 200 cedis monthly will change to 151,873. Adding them will give you 158,601. Then let's say still now you forgo that one and then you started at 55. With 55, your $1,000 will now change to 2,593. And then your 200 cedis monthly compounded annuity will now change to 40,969, which will give you a total of 43,562. So you can do this. You don't necessarily need to start with 1,000. Maybe you might not be having, you can start with 100 cedis, then change here to 20 cedis each and every month, and then you see the impact. Me, after reading this, I've started already. So I'm waiting for you to also start. All right. So now we move to the consolidation phase. So for the consolidation phase, you've passed your career midpoint. You have paid much of the accumulation debt. So the debt that you are owing, you've paid much of it, and then earnings now exceed living expenses. So the balance can be invested. So here you are making more profit, and then you can what? Invest. So time horizon is still long term. So moderately high risk investments are still attractive. So your long-term goals now becomes retirement, and then your short-term goals becomes vacations and then children's school fees. Then move on to the spending phase. So we have accumulation, we have consolidation, we have spending. So at the spending phase, it usually begins at retirement, where you've saved that now you have a lot of money. So what you are doing, what you are spending. All right. So here, savings before and then prudent. So you saved before and then now prudent spending now. And then living expenses covered by social security funds. So your social security funds and retirement plans are paying for your normal expenses. And you have extra reserve. So what are you doing? You are spending the money. But is you are spending some more. So yeah, so changing emphasis towards preservation of capital, but still want investment values to keep pace with inflation. So the gifting phase now can be concurrent with spending phase. If resources allow, individual can now use excess assets to provide gifts to others or individuals. So here you can try and then build an account for people to also get to your stage. You are here, you are going to be gifting. Mom will do gifting stage in some part of mommy also. Why? So here you can also do a start estate planning becomes important, especially tax considerations. So we are done with the individual investors life cycle, which starts at what? Hey, which starts at the accumulation, consolidation, spending, and then the gift stage, right? Okay. So now let's move to portfolio management process. So we have a 4-step process. First, you construct a policy statement, then you study current financial conditions and forecast future trends, and then construct a portfolio, and then now you monitor your portfolio. So let's talk about this here. So policy statement. So the policy statement specifies investment goals and acceptable risk levels. The roadmap that guides all, this is the roadmap that guides all investment decisions. It creates a standard by which to judge portfolio performance. So the second point is study current financial and economic conditions and forecast future trends. Determine strategies that should meet goals with expected environment. Then it also requires monitoring and updates since financial markets are ever changing. Then we move on to the construction of the portfolio. So here, given the policy statements and the expected conditions, we go about investing. So here, allocate available funds to meet goal while managing risk. And then 4, we monitor and then update. So revise policy statements when needed, and then monitor changing financial economic conditions also. Then you have to also evaluate the portfolio performance. Is it giving you enough returns? Is it giving you profit? Then in case if it is not giving you profit or your expected returns, then you modify the portfolio investment accordingly. So here, the policy statement, understand and then articulate realistic goals. Don't make up your mind that you are investing to come and get 1 billion in just 1 year. Like, let it be realistic. So here, you know yourself, know the risk and potential rewards from investment, so that in case it goes wayward, you don't really get mad at anyone or at yourself. So learn about standards for evaluating performance, and then know how to judge average performance. Then adjust for risk. So don't try to navigate without a map. It is not, and that's why in the beginning of every semester, I try to what? Set my personal calendar, my personal learning map, right? So with that one, you are able to move on. Even when you miss some days, you know that, okay, I missed this. Let me try and then do something to replace that. But if you are trying to navigate without a map, you get missing or you get lost. Important input. So investment objective and then constraints. So investment objectives. So you need to specify the returns and risk objectives. You need to consider the risk tolerance of the investor. If in case it's you have to consider your risk tolerance. And the return goals need to be consistent with risk tolerance, right? These will change over time. Then possible broad goals. So the most of the objective for what investing, as you know already, can be of what capital preservation. We are preserving our capital to maintain our purchasing power and also minimize the risk of loss. And then capital appreciation, increasing what our portfolio. So achieve portfolio growth through capital gains and then accepting greater risk. And then also current income, like we gaining some kind of income out of it, right? Then total return, which includes capital appreciation and also what income towards us. So combining income returns and reinvestment with capital gains, which also has what a moderate risk. So here it has a low risk. The investment constraints. What are constraints? Constraints are what will be limiting you from achieving your objectives. So here, your investment is basically you have an investment objective of, let's say, capital appreciation. What is going to limit you from that, right? First, we have liquidity needs. How soon will you need the money, right? We also have time horizon. How able is the investors to ride over several bad years? For example, I have a friend who wanted to invest in Bitcoin, right? So when he saw that Bitcoin was at I'm coming. Let me show you something. So when this friend saw that Bitcoin was going up, those times Bitcoin was around 68,000, right? So he heard, oh, Bitcoin is going up, Bitcoin is going up, Bitcoin is going up. That was when he wanted to invest. And I told him that because Bitcoin has reached like 68,000, it's if you really want to invest in then be planning to hold the money for a very long time because Bitcoin being at the top will likely come down before we go up. He said, oh, don't worry. Then he purchased Bitcoin of I think $500. Then 68,000 Bitcoin fell from the 68,000 up to almost 16,000. Then my friend's $500 was now looking was now around $120 or $130 or so. He was calling me. My money is going down. I told you to wait. And then wait, like I told you to wait for Bitcoin to come down some more before you enter. You were like, oh, the thing is going up, it will go up. Now you have to wait because Bitcoin will automatically will come up, but it will take time. Oh, okay, so with hope and prayer, I thought, oh, it will come up, oh, it will come up, oh, it will come up. Just this year, Bitcoin came back to 68,000. And then, oh, and below, he was investing in Binance. In which Binance, you can do savings where you can get some kind of percentages of Bitcoin each and every year. So he was receiving interest on his Bitcoin savings, and also Bitcoin appreciated and then came around 100K. So when Bitcoin got to 100K, I think his money was around $800 or so. That was when he cashed out. Sharp. So, so you see, you held $500 for uh for almost since 2021 up to 2024 before you cashed out. You can see the stress, right? So Bitcoin came down and then his $500 turned to 120 to $130. He was crying anyhow. Now when it came to $800, $900, almost $900, he cashed out and then he was happy. And I told him that's how the investment process works. You don't just put in something and then expect instant, right? It works in a gradual process and there might be bad days. You have to wait for everything to turn out for good, right? All right. So that's the time horizon. So for example, the Bitcoin case was like 4 years, right? So we also have legal and regulatory factors. So legal factors can restrict you from investing in some particular assets, right? So for example, even if let's say men's gold is still in, let's say if it is still in session, for example, it is not legally advisable for you to what? Invest in men's gold, right? So legalities and regulatory factors will limit you from either investing your full amount in a particular asset or investing in some particular asset. So here in Ghana, here are some legal requirements. So here you can read this. They are self-explanatory. Except with the prior approval of the commission, the manager shall not for or on behalf of a scheme invest in commodities, future or options, and then invest more than 10% of whatsoever. So here, these are more self-explanatory. So you can go through them, understand them. They are self-explanatory. Yeah, many. Take time. So we also have tax concerns. So remember, tax concerns are sometimes uh, constraints to us because it will what change. You see, your realized capital gains versus the ordinary income. You will be taxed, and then your this thing will reduce, right? Then you also have unique needs and preference. Perhaps the investor wishes to avoid certain types of investment. So some, for example, some investors don't want to invest in beer companies because they don't actually take BS. So with that one too, they will also choose their unique needs and then preferences. So let me see, security markets. All right, so yeah, this is where we end today's session. I hope it was brief and straightforward. So in the next session, we are going to cover week 4 and 5, and then we'll, I think we in class we are at week 6. So we'll be there very soon, and then we will be up to par. All right, so if in case you are new to this channel, kindly like this video and also subscribe. Share to your friends. You can tell 10 friends to subscribe to my channel for me. God bless you. God bless you. God bless you. Please like this video and then share it to your friends. If in case you have any questions, you can drop it in the comment section. I'll be there to add up and then explain some what I say. It's your boy, Nehemiah, and Fearfully Ugly. See you another time. Bye.